Good morning, everybody. Minister, ladies and gentlemen. Always a pleasure to speak today. This is a dialogue that's taking place just after the 5th EU Asia Pacific Financial Regulatory Forum, which brought together yesterday the Commission, FISMA, and many of the financial regulators from the Asia Pacific jurisdictions. Now, this year, the forum, of course, took place online, being organized with the Securities and Exchange Commission of Thailand, and it covered various topics, including the state of the economy and regulatory developments in the context of COVID-19, sustainable finance, digitalization, as well as further cross-border regulatory issues such as benchmark reforms, CCP oversight, and deference. We here in the EU very much value this opportunity to talk to our counterparts in the Asia Pacific region. We are made in Europe, as you know, for regional cooperation, and we really value region-to-region discussions as they can contribute to a mutual understanding and can facilitate regulatory cooperation between us and indeed across the world. Now, in the EU, we have taken a decisive path towards economic and financial integration, and we have in place the necessary institutions to ensure that we have a regulated and supervised EU market. But of course, because the EU is also made up of member states, we fully understand the challenges for the financial system deriving from operating across national jurisdictions. So I'd like to take the next few minutes, if I could, to explain to you how the economy and the financial sector in the EU have been impacted by COVID and how we are now recovering from it. I'll then highlight a few of the regulatory priorities for us in the European Commission in 2021. But let me start with setting out where we are in the crisis and my expectations for the following months. Our latest economic forecast foresees that in this quarter, many of the pandemic containment measures will remain fully in place, but we will still see some further contraction, I think, in the economy. However, we expect growth to set in from the late spring into the early summer and to gather momentum across the rest of the year. So going forward, we project a recovery for 2021 as a whole. We expect the EU economy to grow by about 3.7% this year and 3.9% next year. However, there is undoubtedly the risk and indeed the likelihood that the crisis could leave deep scars in the EU economy and society, notably through widespread bankruptcies and, of course, job losses. So a strong European response is crucial to tackle issues such as unemployment and the weakened corporate sector and, of course, growing inequalities. Therefore, we've taken a collective step within the EU with an EU-wide recovery instrument, which we call Next Generation EU. And this aims at supporting recovery and reform in all the member states, most notably in the green and digital areas. We believe Next Generation EU will help to restore and rebuild the EU's single market and enable investment in technologies that will spark the recovery through innovative and clean activities. So it will therefore strengthen our European Green Deal and our efforts to boost sustainable investment. So that's a little bit the economic context in which we work. And now I want to turn to a few of the priorities which are on the Commission's list this year. I think a prerequisite for a strong and sustainable recovery after the pandemic will be to prevent a buildup of non-performing loans in banks' balance sheets. This is a kind of key lesson we learned from the last crisis, when troubled assets clogged up the banks' balance sheets and hence lowered their capacity to extend credit to households and companies. Now, the average non-performing loan ratio in the EU has remained rather stable in this year at 2.7%. But the massive impact of the pandemic on the economy is certain to translate into an increase in non-performing loans and defaults as we go forward into the recovery phase. The Commission put in place a non-performing loans action plan at the end of 2020. And in that plan, we're making the necessary preparations to ensure a stable banking system that is able to contribute to a sustainable recovery. The action plan covers 4 main areas. The first is a set of measures to improve liquidity, transparency, and trading of secondary NPL markets. I mean, if banks are better able to offload NPLs from their balance sheet via secondary markets, this will free up space for new lending. Our second policy area is to improve and coordinate insolvency frameworks across the EU so that the loan enforcement process can become more efficient. A third area is providing guidance for how national asset management companies can be set up by member states, because again, we believe these AMCs can help to free bank balance sheets from NPLs. And lastly, we have clarified the application of our resolution and competition rules in the specific context of the COVID crisis. I think flanked by these other more broader economic policy efforts through Next Generation EU and the member states, we are convinced that we will allow the EU banking sector to manage any future wave of NPLs. Another priority going forward will, of course, be a need for a green recovery. And this brings me to the topic of sustainable finance. The COVID-19 outbreak and the economic consequences have revealed the insufficient integration of sustainability considerations into our economies as well. And the current crisis has also catalyzed a change, I think, in citizens' expectations, both for companies and the financial system overall, to deliver on social objectives. So it opens the possibility for necessary and fundamental changes in companies' business models and financial frameworks to adapt to these changes. So a green and resilient and equitable recovery is indispensable, we believe, to prevent massive disruption related to the consequences of climate change and to benefit from economic opportunities going forward. And so to this end, we will need enormous amounts of investment and enormous amount of private investment. And that investment should be primarily directed towards sustainable activities and those activities that do no significant harm to the environment. For investments to be based on sustainable foundations, the EU taxonomy, which we have now put in place, will play a key role. We want it to be a trustworthy tool that translates the EU's green objectives into criteria for investment purposes. It does this because the taxonomy will help compare the level of greenness across various investments, and it can therefore guide market participants in their investment decisions. The EU taxonomy sets out clear, scientifically based criteria which determines the greenness of assets and establishes whether those projects are in fact conducive to the zero emission targets that we have set in the Green Deal. At present, we are completing the work on the taxonomy. We are moving from principles to more detailed technical criteria, and that work will continue this year and indeed next year. In addition to the taxonomy, of course, we're putting in place disclosure requirements that will be aligned to the taxonomy, and we believe these will further facilitate investors in choosing sustainable investments. Alongside this green transition, of course, we want to work on a digital transition. And the future of finance is, of course, also digital. Citizens and businesses have been increasingly accessing financial services in digital form. Innovative market participants are deploying new technologies, and they're challenging the traditional business models. As well, all Europeans, I think everybody around the world, has seen how digital finance benefits them concretely when it allowed them to manage their finances during the COVID-19 lockdowns. So the further digitalization of financial services, we believe, will support the recovery from the COVID-induced economic downturn and will also help EU citizens in their everyday lives. And I want to stress here that we are already engaging with our regulatory partners in Asia on digital finance, and it's top of our agenda. As evidence of that, you will know that last December, Commissioner McGuinness spoke at the Singapore FinTech Festival. Now in Europe, as you know, we presented in September 2020 a digital finance strategy. We believe digital technologies are key, as I said, to relaunching and modernizing the European economy across sectors and to moving Europe forward as a global digital player. And that digital finance strategy reflects this. objective. In it, we made a proposal to regulate crypto assets to ensure that there's an appropriate oversight on a market which is experiencing a rapid development. And we made a proposal to regulate digital operational resilience. Both proposals are currently being negotiated by our co-legislators in the EU lawmaking process. We're also looking into how big technology companies and large platforms are entering financial services. We need to make sure that the benefits they can bring for consumers and businesses do not come with harmful practices and increased prudential risks. We're also examining how our financial regulation and supervision must adjust in order to ensure that all risks are properly covered along the same activity, same risks, same rules principle. Technology companies need to face the same prudential rules and supervision as traditional banks, insurance, or investment companies do when they provide the same services. Embracing digital finance, we believe, would unleash European innovation and create opportunities to develop better financial products for consumers, including for people currently unable to access financial services at all. It also unlocks new ways of channeling funding to EU businesses, and in particular, small and medium-sized enterprises. Let me now just say a few words about our efforts, our ongoing and long-standing efforts to build a single capital market and the banking union. I mean, both the green and digital reforms are best addressed if financial markets elsewhere are well integrated. The EU single market, of course, provides scale to develop innovative and transformative projects. And integrated capital markets are essentially necessary to provide an efficient allocation of capital and offer firms the opportunity to raise capital for their investments and offer investors ample possibility to diversify and specialize. The Capital Markets Union has been and remains one of the key projects to enhance our financial system in the EU. With larger and more developed capital markets, we will reduce companies' over-reliance on bank lending in the EU also. Capital markets will therefore be vital to the recovery, but also to the longer-term growth, because public financing alone will not be enough to get our economies back on track. We've already taken targeted measures to facilitate access to capital in the crisis context. We will continue our efforts to reduce the cost of access to capital for SMEs, in particular by further acting on rules that affect direct and indirect listing costs, and advance our proposal to establish a pan-European public-private fund to support SME IPOs. This would help to crowd in investments and to attract institutional investors into the EU companies with high growth potential. But of course, stronger capital markets also need strong banks. And following the 2007 and 8 financial crisis, the EU put in place a single rulebook for bank supervision, resolution, and deposit protection. And today, the ECB is a supervisor for 100 plus banks in the euro area, and the Single Resolution Board is the resolution authority for all those banks in the euro area. Overall, the banking union ensures that we have a solid and stable banking sector in Europe, which can take full advantage of the single market. Indeed, market integration generally increases access to funding, lowers the cost of capital, and contributes to risk diversification. And this is true in the banking sector as well. We need to do more work on the European Deposit Insurance Scheme, EDIS, that is the third pillar of banking union, and that is underway. And we've also recently launched a public consultation on the review of the crisis management and deposit insurance framework. And we're holding a conference on that in the next few days, in fact, on the 18th of March. So I've gone through a long list of priorities for the Commission, but before I conclude, I want to say just a couple of words on the withdrawal of the UK from the EU, which I know is an important event for many in the financial sector now that the trade and cooperation agreement is in place. As I said, in December 2020, we concluded the trade and cooperation agreement, and that now provides a clear basis for continued trade in goods and services. The fact that the UK has left the single market, the customs union, and the EU's more general policy sphere inevitably has far-reaching consequences affecting citizens, businesses, and stakeholders, both in the EU and the UK. For the financial services sector, the withdrawal of the UK has resulted in a change of regime for all firms active in both the EU and the UK, as UK authorised firms can no longer provide services across the EU based on their UK authorisation, the so-called passport. The transition to the new situation, I think, went very smoothly. It was a discreet move at the end of last year. And I think much of the credit for this smooth transition goes to market participants themselves and the preparations they made. We haven't seen any volatility. We haven't seen any major disruption. Now we have to move forward in developing our future bilateral relationship with the UK in financial services. We are committed to establish a framework for regulatory cooperation on financial services with the UK by the end of March 2021. We aim at setting up a flexible, non-binding framework, similar to what we have with the United States. Technical negotiations with the UK on this framework are ongoing, and once we have it in place, we will then resume our discussion around equivalence and decisions related to that. So let me conclude. I think I've spent much of my time. I think the forum we had yesterday, and I'd like to thank again warmly the Thai authorities for having organized it on the Asian side, represents a very useful opportunity to compare experience, to better understand each other and to see how we can respond to common challenges. The green and digital transitions here in EU represent significant challenges, but even more significant opportunities. And all the more if we're able to scale those responses, those transitions up at global level as well as on at EU level. International financial regulatory cooperation as well as cooperation with the business community is essential. We can recover from the crisis more rapidly and more effectively, of course, if we all work together and consistently. I think today's dialogue, as well as yesterday's forum, are clear examples of how we can contribute to mutual understanding between the EU and Asia, between financial regulators and the business community as well. And in face of new and common challenges to our financial systems, of course, we need to continue this coordination effort in the future. I want to thank you again for your attention, and I hand the floor back to Nick. Thank you very much.
Sean, thank you very much indeed. Maybe just if you've got for a minute or two questions which have come in, and they're quite related. Thanks on finishing on the UK. Obviously, there's some anxiety that the ongoing discussions about equivalence in the course of this year will have a knock-on effect on any equivalence discussions or deference discussions with other parts of the world, including Asia. And maybe you can elaborate whether you see some interlinkage there or whether those are totally separate processes from jurisdiction to jurisdiction. Because as you say, a lot of regulation will be amended over the next few years, and there's a concern that the third country regimes that are already in place or foreseen under that legislation might be changed as well to take into account of Brexit. And linked to that, a question that comes up in this forum every year, the benchmark regulation. It caught a lot of players in Asia by surprise that they suddenly had to establish administrators for the sake of European benchmark legislation. And I think that extraterritorial effect is seen again and again and driving things. So I don't know, there's a plan to revise the BMR again, the benchmark regulation. Maybe some thoughts on that. Thank you, Sean.
Thanks, Nick. Well, maybe on Brexit first. As I've explained, I had to explain throughout the 4 years after the decision to leave itself, it is, of course, a big challenge to take a very large part of your EU financial system and move it from being a domestic component of the EU to being to put it into the third country framework without disturbing the rest of that third country framework. We recognize that as a challenge from the beginning, and we put in place, I think, the necessary procedures to manage that. So the objective has been all along to manage this transition of the UK from intra to extra jurisdictional status while having as little effect as possible on the remaining part of the third country framework. We're dedicating resources to this process, so it's not even a case that we will not be able to handle equivalence decisions. We have dedicated resources. So we're doing the best we can to ensure that in integrating the UK into the third country framework, we disrupt as little as possible, both the operation of the third country framework and the timelines for decisions within that framework. Now, I cannot promise you that there will be no effect at all, but our intention is not to allow the work we have to do on the UK or the processes we need to put in place for the UK to affect what we have in place for other countries. And I mean, EMIR 2.2 is an example of that, where because we knew we were bringing in we're transferring some rather large and systemic infrastructures from inside the EU to the third country framework, we would have to manage that somehow. And EMIR 2.2, which of course allows us to kind of graduate equivalence and equivalent conditions based on systemic importance, has helped us there to at least have the opportunity to integrate the UK into the third country framework, while at the same time preserving the relations that we have elsewhere. So I think I wouldn't overly worry about it. We're trying, we cannot say there's no effect, but we're trying to minimize those effects. On the BMR, there's no immediate intention to reform it. Our main focus around the BMR, as you know, at the moment is trying to manage the process of LIBOR cessation. So I think that is where our focus is on the BMR for the moment. I don't think we'll be making any further changes to it in the near term. Our focus, as I said, mainly on trying to manage the LIBOR cessation process at the moment.
Thank you, Sean. And I know we've got an extra few years for third country administrators to register, so maybe that helps a bit. But I think the issue will not go away. I think you will hear about benchmark regulation again in our 8th forum. But for now, I think thank you very much, as always. I know you're very busy and have a lot to do, so it's always a pleasure to have you with us and being so candid and succinct in the way you set things out. And good luck with the work, particularly on the Memorandum of Understanding, whatever it will be, by the end of March. Hopefully you will replace all the words US by UK in the appropriate 3-page document. But I leave it at that.
Yes, you better.
Okay,
thanks a lot, Nick.
Thanks very much, Sean. All the best.
Thank you. Bye-bye.
Have a good day. Thank you.
Thank you.